cannot retrace more than a 100% retracement. Does this make sense to you guys? I'm hoping it makes some sense to you. Now, the intermediate trend looks big. It looks obvious to you, but you can imagine how frustrating it would be if you're trying to trade the intermediate trend. You go short here, you come down, but look at all these little jigs and zags in here. These zigs and zags drive you crazy, and a lot of times you're getting stopped out. What are those additional moves? That is the minor level of the trend. Now, the minor level of the trend is going to work with the intermediate trend. It's going to go in the direction of the intermediate trend at times, and at times it's going to work against it because it's little impulsive and little corrective moves that work with the intermediate trend. The intermediate trend, again, is a large impulsive and a large corrective move that works with the primary trend. The primary trend is the big picture trend that's controlling all of it. And when you get a primary big picture trend reversal, you have a massive movement in the market. Whenever you have a small intermediate trend reversal, you have a middle-sized movement in the market. It can go for several months. And then whenever you have a minor move, these become the little short-term swings that oftentimes we trade, and they become exceptionally profitable. They can also become the thing that stops you out and makes you exceptionally frustrated. And so that's one of the reasons I really feel it's important for you to understand this. By understanding that there's multiple levels of the market at play, make sure, before you get all frustrated and start blaming market makers and other people for messing you up, make sure you actually are understanding which level of the trend you're dealing with, and make sure you're setting your stops accordingly. All right, hopefully this is some major good stuff for you. I'm seeing a lot of ahas in here, so that's good. All right, the third tenet of Dow theory says a trend has three phases: the accumulation, public participation, and the distribution phase. Accumulation, public participation, and distribution. I'm going to talk more about this, but I'll be back. I've put it later in your notes because I don't want to get off too far on my Dow theory discussion. Okay, so trends have three phases. Now, the fourth tenet of Dow theory says that the averages must confirm themselves. Whenever we talk about the averages, what are the averages? Well, the averages refer to the two Dow Jones averages. We have the industrial and we have the transportation averages. Now, whenever Charles Dow set them up, the transportation average was actually what he referred to as the rail average. Since that time, we've had a little bit of progress in the world of transportation. And so now we've got a broader index or a broader average, and we refer to it as the transportation average. And so the theory says that the averages must confirm each other. Now, the way Charles Dow looked at these industrial and transportation averages was maybe a little bit different than you would have thought. The way that Charles Dow looked at the averages is he looked at them as what he referred to as a, quote, barometer. In other words, it was like a thermostat measuring the economy. And his theory said that if you could average together a basket or a handful of stocks and you could get a pulse on what the majority of market participants were doing with that handful of reliable stocks, then you had a really good idea of what the overall economy was doing. That's the theory of having an average. And of course, that theory has picked up and it's moved on. We have averages of everything these days. Now, in case you're not familiar with why we have averages because, this is a very good market principle, by the way. We have averages because the majority of stocks tend to move in the same direction. The majority of stocks tend to move in the same direction. So if you're in a bullish market, it's easy to make money buying long because the majority of stocks are going to eventually go up. That's why if you're in a long-term bullish market, like we have been in some years, not the most recent years, but between early 1980s and late 1990s, we were in a long-term bullish market. And so that's why people could say during that time period that if you just bought and held stock for 20 years, eventually it would go up. Well, that's because the overall market was bullish, long-term it was bullish, and the majority of market participants or majority of stocks eventually go to the same direction. Okay, now the markets have changed. So you get into a bearish market, and what happens? Well, the majority of stocks go down together in a bearish market. So if you're in a bearish market, everybody can make money in a bearish market shorting. And you could say the same principle. Well, if we're in an overall grand macro bearish move, then you just short and eventually everything will go down together. That would be the idea if you were to follow the same logic of the buy and hold principle for a bullish market. It would be a short and hold principle for a bearish market, right? So that's the nature nature of where the averages come from. You say, well, let's average them together. And if the overall trend is up, then the overall economy is good. If the overall trend is down, then the overall economy is bad. Now, the theory that Charles Dow proposed is that if the two averages are not in sync, in other words, if they're not confirming each other, then the overall trend of the overall economy is suspect. And the way that he reasoned it is he said if the industry is producing the goods, then the transportation must be delivering the goods. So the idea is if transportation slow down, then industry will eventually have to slow down as well. I've highlighted two areas on here where we've got a divergence of market movement in the industrial and the transportation averages. On the bottom here, you see the transports. Let me zoom in here. There we go. On the bottom, you see the transports, DJTA, and up top, you see the industrials, okay, because that's what I put up here. Notice this divergence where the industrials made higher highs, whereas the transports made lower highs. You see this? This is a divergence of confirmation. And is it interesting that that divergence of confirmation happened right before the end of 2008? Does anybody know what was happening roughly around September, October 2007? Does anybody have any clue what was happening? Yeah, the markets were not quite crashing yet, Kathleen. We were preparing for the market crash, but the housing bust, that's right. We were having a credit crisis that was just getting wound up. And so you actually saw it being revealed in a divergence of the overall markets during that time period right there. We had a quick correction where they got in sync, but notice what happened. Lower highs and lower lows as the overall market crashed. The transports crashed as well. And they've pretty much been in sync since then until present time. Now, this divergence has been going on for quite a while. I've been watching this divergence since the beginning of the year. This is, the end of 2011 into 2012 right here. And the overall indexes have made higher moves, and the transports are continuing to make lower highs, relatively speaking. So this could be the precursor of a major reversal. Here's what I can say. While we can't necessarily time the market on this particular index right here, we don't want to time a reversal based on that. What we can say is we can say that the broad-based economy, is bad. That's the one thing you can say. And would you agree with that general statement? If I were to sit here and say, hey, ladies and gentlemen, the industrials and the transports are in divergence, that signals that the overall economy is bad. Would that agree with what you guys know about the overall economy right now? Would you guys think that the overall economy is bad? And a lot of you are saying, yes, absolutely. And I would suggest to you that the overall economy is full of uncertainty for sure. I mean, we've got all sorts of things going on overseas. We got all sorts of weakness here in America as well. So, while unemployment may not be 110% unemployment, it's not great. And while we are getting some job growth, it pretty much stinks, and the economy is just not growing. That's just kind of the fundamental facts. So here you see it laid out, and you see how the industrial and the transport averages are actually predicting that. And this could suggest that towards the end of this year, or even into 2013, 2014, that we're going to see another substantial market sell-off. And based on history, that market sell-off would probably look something like 2008. Give or take a little bit. We don't necessarily know at this point. That's not the nature of this class tonight. I'm just talking about the industrial averages. All right, so moving forward here, the next tenet of Dow theory says that the volume must confirm the trend. What does that mean? Well, very simply put, volume must confirm the trend. Volume is assumed to move with the direction of the masses. In other words, when the majority of market participants are bullish, we will see a bullish move, and we will see the volume increasing with that bullish move. If the majority of market participants are bearish, we will see a bearish move, and the volume will increase with that bearish move. Either direction, volume should be increasing. It shows that the masses are jumping on board. So weak volume indicates a possible weak trend, whether it's bullish or bearish. Now take a look at this picture that I've highlighted out here for you. And I want to show you in the green area, notice that we've got an increase in volume. The green and red go with increase in volume, not with the stock price itself. Okay, so take a look here. Notice that during this little bullish swing, we had an increase in volume. Now notice what happened during this little sideways move. We had a decrease in volume. And then as the bullishness got roaring up again, we had another increase in volume. As we stabilized up top here, we had a decrease in volume. As the bearishness started to ensue, we got an increase in volume. As we stabilized the counter move to the bearish swing, we had lower volume. And then as the bullishness came back in, we initially had some bullish volume, but watch what happened. The bullishness came in, but the volume did not. You see that? So I'm just looking at the first part of the yellow section here. Initially, bullishness happened. Initially, we had some good volume. Then bullishness happened, volume did not, and consequently, the trend did not sustain. That's the story of that picture right there. The volume did not follow the trend, and the trend did not sustain. It corrected, and then watch what happened. The next section of green, as the bearishness came back in, the volume increased again, and then as you pretty much go the rest of the year, I kind of faded it out there, but as you go the rest of the year, you notice the price action slowed down substantially and volume stabilized substantially. We had a few little spikes here and there, but overall it stabilized substantially for Alaska Airlines during this time period here. Okay, so you can see what happened is the volume is following the expansion of the majority of market participants. Okay, does this make sense to you? Now someone says here, and this is getting ahead a little bit, Sorty says, does this mean, hence the double tops, what she said, and what she's looking at, and I haven't taught you guys chart patterns yet, but what she's looking at is this double top, and the answer is yes. In fact, this is typical double top behavior. Very often you will get no or a little bit of a volume rally going into the first peak of the double top. You will have a contraction of volume on the first valley, contraction of volume on the second peak, and then an increase of volume on the final sell-off where the double top breaks. So yes, you're absolutely correct, hence the double top. Okay. Now in reality, this thing did not reverse massively because you see there's a stock split here. So we had an initial run up into the stock split, we had the initial reversal, and then it's basically stabilized for the most part after that during this this time period in through here. Haven't had a much fluctuation, $5 or $6, but really not a huge fluctuation for the last several months in this particular trade. But yeah, that's why it says that there. All right, let's go to the sixth tenet here. Sixth tenet of Dow theory says that trends stay in motion. A trend is assumed to be in effect until it gives definite signals that it has reversed, just like the laws of physics. An object in motion tends to stay in motion. Same thing is true with a trend. We assume that a trend is still going to be the dominant force until we have evidence to suggest otherwise. So if a primary trend has not reversed, we assume that the primary trend is still in force. If an intermediate trend has not reversed, we assume that the intermediate trend is still in effect until it does reverse. And then once it reverses, then obviously we trade it effectively or trade it accordingly. So how do we put that into practice? Well, let's take a look at this picture of the euro. Notice that the euro has been in a decline since at least the beginning of May here in 2011. Notice the sell-off, the rally, the sell-off, the rally, and all of this was really intermediate level. You have the clear trend running through here. So was this a reversal? It was not. The intermediate trend continued bearish. The intermediate trend came back up. Now, as the intermediate trend gets into the primary trend zone range here, what happened? It reverses and it continues. And then as the intermediate trend comes back up into that general zone, what happens? It reverses and it continues. And you can see what happens here. The intermediate trend is working in conjunction with the primary trend. Sometimes it's bullish, sometimes it's bearish, but the primary trend is still in effect. And as of today, this trend has not reversed. Now, does that mean there's not a bullish trade? Well, actually, I would suggest potentially the exact opposite right now as this particular trade starts to reverse here. We might have another intermediate run up that would potentially take us up to 128 or so, which would coincide with the primary trend. Oops, that was a bad line there. Forgive me. Let me see if I can't do that a little more professionally. There you have it. So you guys see the idea? The primary trend is still in effect. And so a trend is assumed to be in effect. A trend is assumed to be in effect until it's given definite signals that the trend has reversed. Okay? Now, how many of you think this is pretty fascinating? Are you guys fascinated by this entire study of Dow theory? I think this is just the coolest stuff in the world. I really do. All right, I'm not done. I got more. I got at least 20 more minutes. Is that cool? What I want to bring this whole discussion into is I want to actually zero back in on the third tenet of Dow theory, which says that a trend has 3 phases, because this helps us understand the psychology of what's going on in the individual phases of a trend and why markets reverse. So I'm going to start this discussion asking the question, what causes a stock's price to move? What causes a stock's price to move? Any ideas? Speculation, says Yev, as we've already discussed tonight. Demand, says Casimir. Did I say that right? Sentiment to the trader, says LM. That's a good one. News, says DG. I got news, I got fear and greed, I got people, I got perspective, I got speculation, emotion of those buying. All of you are very, very close. I'm going to define it this way. What causes a stock's price to move is perspective, and the question then becomes whose perspective? Whose perspective is causing the stock's price to move? When we get into a bullish trend, whose perspective caused it to move? When we get into a bearish trend, whose perspective caused it to move? And I would suggest to you that in both cases, the driving force of the stock's price move is the people that we refer to as the uninformed trader, also known as the average trader. Now, who's an average trader? Any idea who's the average trader? The average trader is, simply put, the majority. When the majority of market participants come to a conclusion, whether it makes fundamental logical sense or not, the stock will move in that direction. When the majority of market participants come to a conclusion, whether it makes logical, fundamental sense or not, the stock will move in that direction. So if you come back to July of 2010 for 3M, the majority of market participants decided that 3M was a good deal, and over this trend, they won. The majority of market participants are always required. What am I doing here? Learn to spell, Jay. There you go. The majority of market participants obviously had to be bullish to drive this market up from $75 a share, ultimately all the way up here to just under $100 a share. Now, what happened when we got into August and the sentiment completely changed? Who drove the market back down? And the answer is the same people, the majority. In both cases, the driving force of the market is always the majority of market participants. The study of technical analysis is the study of herd behavior, the study of the majority. What's the majority thinking? And so as the majority starts to believe one thing, that's when the market rolls over. Do you remember the quote that I gave you from O'Shea earlier in the evening? When I was talking about the not the new market, thank Jeremy, the Hedge Fund Market Wizards book. And I gave you the quote, and he said that it doesn't matter what the fundamentals say if the people don't believe it or if they don't care, I think was the word he said, if they don't care. Well, if the majority doesn't care, then they have not become emotionally involved. But when the majority starts to care, they become emotionally involved, and they either drive the market up or they sell the market off in an emotional fit. This is not a logical fit. This is irrational, and it is emotional. Always remember that. The market is emotionally driven. It's driven by the majority of market participants. We know that the majority of market participants cannot sit there and do all the data research and figure out what the core fundamental data is and what the real value is. So they finally give up and they eventually trade on emotion. So when that emotion becomes in sync with the majority of market participants, and the majority of market participants are bullish, markets drive up. When the majority of market participants become bearish, markets sell off. Now, here's the conundrum. This is really the puzzle. The question is, why does a stock's price stop moving? And I got to clear my screen out because I just got too many things going on here. So what causes a stock's price to move? And now the question is, what causes a stock's price to stop moving? And the answer that I would hypothesize for you is what we're going to refer to as the informed trader. Now, who is the informed trader? I'll tell you who the informed trader is. The informed trader is the trader who looks at this during the bullish move and says, gosh, we're sitting at a resistance. It's time to sell. As the market sells off, that bullish optimism that the majority held continues to drive the market up, but the informed trader shows back up and says, gosh, it's time to sell again. In other words, the informed trader is the market participants who can look at key turning points in the market and says, that's my buy point, that's my buy point, that's my sell point, that's my sell point. And what happens is the informed trader is not strong enough to drive the market, but the informed trader is strong enough and is large enough to establish the market. And more specifically, to establish market boundaries. The informed trader is large enough to establish market boundaries. And what they do is the informed traders help to solidify these technical levels that we're all dealing with. The reason we want to identify support and resistance is because by identifying support and resistance, we're identifying not to the penny where a stock should turn, but we're identifying to a region. In this region, the informed traders start to show up and make some trading decisions. They are the real factor of the market. Now, the informed trader is not strong enough to drive the market. What's it take to drive the market? It takes the majority. It takes the majority to drive the market, but the majority has no clue what the real value of the stock should be. They don't have a fundamental clue and they don't have a technical clue, the majority. So the majority buys on irrational, emotional decisions. The majority buys, driving the market up, or they sell in a panic, driving the market down. Doesn't matter if logic is involved or not. They are emotional. The boundaries get established by the informed traders. And this leads us back full circle into that third tenet of Dow theory. That third tenet of Dow theory suggests that trends have three phases. And it's just miraculous to me that Charles Dow discovered this over 100 years ago. But it is as true today as it has ever been. Trends have three phases. They are the accumulation, public participation, and the distribution phase. The first phase, the accumulation phase, this is when the informed investors begin to take on new positions. They start to establish their bullish positions. Now, the reasons that they establish them, it does not matter. The point is they are establishing new positions. It appears that they look contrarian. Now, a lot of people say you should be market contrarians. That's stupid. You should be market informed. However, what it appears oftentimes is that the winning traders look contrarian. It's not because they are inherently contrarian. It's because they're informed market participants. If you want to learn who the market participants are that are more informed, I would suggest you read books like the Market Wizards book. One of the things that I was thinking about in reading that this weekend is Exactly what I just described to you. There was actually, I forget now who the interview was with, but one of the questions that he said is he made the statement, he said that, hey, it sounds like you're contrarian. And the guy responded, no, it's just where I should be buying. And that's exactly the misphilosophy or the misunderstanding of the philosophy of contrarian opinion. A lot of people believe that winning investors are just by nature contrarian. That is not true. It's just that the winning position appears contrarian at the outset. So while the stock is appearing extremely bearish, the informed trader, for whatever reasons, are taking on new positions. At this time, the news and the sentiment is very poor. It appears that everything is exceptionally negative. The news is telling you everything is going to hell in a handbasket. The news says sell, sell, sell. And these contrarian investors, as they appear to be, are actually buying for either maybe a technical reason, such as we're at the support that they had marked, or maybe because they're a fundamental trader and they start to see signs that the sell-off is weakening, and maybe as O'Shea would have suggested, hey, the sell-off is weakening and I'm fundamentally strong on this, so I'm going to, as the technicals reverse, I'm going to jump in and I'm going to buy and establish some new positions. Doesn't really matter what their logic is. The point is these informed traders are buying, and as that buying pressure starts to build, they start to accumulate and establish the foundation. It's an accumulation period. Okay, volume during this time period is generally speaking pretty low. Now, once the accumulation period is over, the market starts to rise a little bit and the public participation period starts to come in. During the public participation period, we have a steady increase in activity, and the squibbishness or the fear in buying that people had starts to turn into a more confident buying. As that more confident buying comes into play, eventually it evolves into full-on buying frenzy. What is a full-on buying frenzy? That's when the buying pressure is just driving the market straight up. The news becomes exceptionally optimistic. It's the headline of the day, or possibly the headline of the month. And a lot of times you'll hear this on the news networks. Anytime that you've got a bullish stock that starts to become the headline and everybody says you got to jump in, you should be watching and being prepared to jump out, because that's about the time that things are going to reverse. The stocks have already advanced, and the public has finally got their courage together to drive the market up. Now, once we get to the peak of optimism, we get to the next phase of the trend, which is the distribution phase. The distribution phase is when the news is the most bullish, optimism is extremely high, and the fear from the previous decline is just a memory. People don't even know it was there. They've totally forgotten about it several months later. This is the time that the informed traders are closing their positions. In other words, the very people who started the move by accumulating in the beginning are now distributing their positions, taking their profits at the top. They get in at the bottom, they get out at the top. So if you look at the complete cycle, imagine that it goes something like this. You have the accumulation period down here at the bottom. This is when the informed traders start to establish their positions. Now, what is the sentiment? Well, in order to get there, you had a sell-off. You didn't get an accumulation period by having a massive bullish run. No, you had a sell-off, so the fear is extremely high. The emotion of the majority of market participants. Remember, in order for a market to sell off, what has to happen? The majority has to be afraid. The majority has to be bearish. We just talked about that. What causes a stock's price to move? What happens is when the average trader starts to all see the same picture and they start to say, oh crap, we shouldn't be in this thing. They start to sell, they get a panic going, they sell it all off. You get an accumulation period. Once we hit a bottom, we start to sustain a little bit, and the informed traders take on their position. This creates stability, and then the early adopters start to jump into the trade. As they start to jump in, the public starts to jump into the trade. The public eventually drives the trade up until the very people who started it start to take their profits in the distribution cycle. You can see why, especially if this spread over several months, you can see why by the time we got back to the distribution cycle, the fear of the initial sell-off is a distant memory. And it's about that time that the informed traders who took on the initial risk of buying, providing the support, driving the market higher, They close their position, and then they take on the new risk of doing what? What do you think the new risk is that the informed traders take on at the top? The new risk is when everybody's buying, what are the informed traders doing? They are selling short. Now, for everybody who always says you shouldn't have short sellers, is it the short sellers' fault that people are willing to pay too much? The answer is no. It's not the short sellers' fault. They are taking on the full risk. Everybody who's sitting here saying, oh, this is a great stock, the news stories are fantastic, stock's going to run up forever. The informed traders come along and say, I don't think so, but I tell you what, since you think it's going to run up, I'll sell it to you. And, if it doesn't run up, well, that's your fault, not mine. Sure enough, what happens? The cycle continues. Before too long, the public freaks out. We have a panic. We have a sell-off. Now, in order for the market to move, what must happen? The average trader must change their perspective. So the average trader over here was bullish, and the average trader over here becomes bearish. Bearish moves are almost always faster because they usually involve a panic. The panic sell-off drives the market back down, and once we get back to the bottom, who is down here to cover their shorts and pick up the pieces? And of course, the answer is the informed investor who started the whole thing to begin with. Shows back up, says, I think this is a good place to cover my shorts. Yeah, I think I better be buying some more because there's a good thing this cycle might start over. And now you understand the cycle of a trend. Now here is the sad part. The sad part is the majority are focused on the wrong part of the trend. The majority are looking at the market, and when the market runs up very, very high, they believed, oh, I should be buying. It's been going up for 5 months. How many times have you ever listened to a news story on a CNBC or Fox Business on a Saturday morning news show, and you listen to these financial shows, and they have their entertainment factor. They call it financial news, but it's really entertainment. And so you got 3 or 4 guys on this panel. They're making their picks for the week or for the month. And one guy's logic is XYZ company's been going up for 9 months. They've got new management, blah, 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 blah. And so that's his pick for the week. Then the other guy tells him he's an idiot, and blah, blah, blah. Yeah. Whenever you hear those words, it's been going up for 9 months. It's got new management, blah, blah, and it's made it into the news. It's probably nearing a distribution cycle, because when the news hysteria is actually there to pick up on it, the cycle and the trend has already been established, because news media also believes that a trend, once established, will always remain. They fail to recognize the reversal. Okay, so what you want to do is, if you start hearing a lot of news hysteria about it, doesn't mean there's not a short-term trade. There might be a short-term trade, but be very, very careful. Certainly for a long-term position, if there's a lot of news hysteria, be careful, because that's when the panic comes in. And so you get a distribution period, you get a slowing period. The slowing period will look like some sort of a consolidation or a channel or a double top or a head and shoulders, some of the patterns that we're going to discuss in the series of classes coming up here. Anyway, you'll get these topping patterns. That's a distribution period, and then the panic comes in, and once the panic comes in, boom, there's your reversal, and just as fast as the whole thing drove up, it unravels right before you. So the sad part is that the majority of market participants are on the wrong side. Now, let me ask you a question. Why do you think the majority of market participants are on the wrong side? This is an interesting question. Why do you think that the majority are on the wrong side? Emotion? Well, that's pretty good. Here's the answer. It's not greed. No, it's not greed. It's fear. The answer is fear. You see, the majority of market participants, when the market has done this, are full of fear, and they have no courage to go bullish. It's in the face of fear that the informed market participants have the courage to buy. The same is true at the top. It's not greed, it's fear. Fear of missing the opportunity. And so the average market participant says, wow, I thought this thing was just going to be bearish forever. It's been recovering for 12 months now. I think I better jump back in. I'm going to miss my opportunity. And that's when the market sells off. And so in reality, when you face your fears, you can actually find the courage that you need. It's ironic. The majority of market participants are afraid of losing money, and they lose money. We call it the law of attraction. If you're into the world of metaphysics, which I'm really not that much into that world, but if you're into the world of metaphysics, it's a very established study, the law of attraction. The things about which you think come true. So if you're afraid that the market's going to go down, it's going to go down. If you're afraid that you're going to miss the opportunity, you just missed it. You're afraid the market's going to go up, it's going to go up against you. The thing that you fear the most is what comes true, right? And it's no different for the majority of market participants. That's why they're always on the wrong side of the deal. So if you want to be a winner, you got to learn how to look at market formations, establish them, and then learn how to take advantage of them. Now, this one was a little bit interesting on Garmin because we had a long period of kind of not a whole lot of market movement, but notice how we really established down here, really the support level was well established right in here around $30. And we had one initial run up that was only about $4 or $5. It sold back off. We got a really strong accumulation down here. The bullish trend came in. Look at the hysteria at the end. And then this became the distribution period that sets us up for the reversal to come into play. Okay, so question, why does this work? And the answer is simple. Public perception. As long as the public is the driving force of the market, and by the way, they will always be the driving force. As long as the public is the driving force of the market, they will be ruled by human emotion, and they're ruled by the assumption that up is good. Now, here's the interesting thing. It's not just the public. The majority of fund managers, and when I say fund managers, I'm talking about your mutual fund managers, I'm talking about your traditional investment advisors, your financial planning groups. Where do the majority of fund managers and fund people that invest, where do the majority of them get their education? Any answers? We talked about it at the beginning of class. The academic world. Thank you, Ken. The academic world. And as we discussed earlier tonight, the academic world kind of has it all backwards. So is it any wonder that the majority of market participants, whether they are an amateur or whether they are a quote-unquote professional, is it any wonder that the majority of market participants have the assumption that up is good and are always falling victim to human emotion? Is it a wonder? And I would suggest the answer is no, it's not. So what does the technician do to make progress towards overcoming these human emotions, overcome all of these things so we can start making a profit? And I would suggest to you that the role of the technician is to step outside of the market. Rather than focus on being a market participant, the role of the technician is to step outside, observe the market through market behavior as we see it in the charting, and then set our trades up accordingly. And any good market technician is going to have a process of confirmation. So here's what a technician wants to do. A technician wants to study the price action, draw logical conclusions on the trends, and then we take what we would refer to as a weight of the evidence approach, meaning when the majority of the evidence suggests a bullish trade, we would go bullish. When the majority of the evidence suggests a bearish trade, we would move bearish, always with caution, always with the ability and the foresight that we might have to change direction possibly very quickly. So for TradeSmart, we've established our 5 steps to confirmation, and many of you, especially if you're a retake student, you're already familiar with these. Let me just roll through them very fast. 5 steps to trade confirmation. This is what all of level 2 is going to be about, by the way. All of level 2 is going through these 5 steps of confirmation. Okay, so 5 steps for confirmation: your line drawing, your moving averages, your chart patterns, your candlesticks, and your indicators. Ladies and gentlemen, this is where we are going in level 2. The next 4 weeks together, this is what we're going to dig into. Line drawing, moving averages, chart patterns, and candlesticks. Now, and indicators. Now, if you want to simplify just a little bit, I have another way of looking at it. I call it my 4 steps to confirmation. And my 4 steps are line drawing, chart patterns, candlesticks, indicators. All it is you think of it in 4 instead of 5, but the moving averages get moved into the indicator category. You can look at it either way. I don't care how you look at it. I generally call it the 5, and the reason I call it the 5 is because of the way I teach it. In truth, in function, I actually analyze more often with the 4. If you watch through a power trader, I look at my line drawing, I look at chart patterns, candlesticks, and then I go moving averages, and then I go indicators. But in teaching it, it's so much more practical after you got line drawing to have your moving averages in here so you guys can go ahead and get a trend following system in there. That's why I've got the 5th step, just so that it makes more logical sense the way I teach it. But I don't care how you guys think of it, and you guys can think of it however you want to. Okay, there we have it. Introduction into technical analysis tonight. Here are your action steps for the evening. You guys really need to go online, take those quizzes, those fantastic quizzes that Paul has put together for this program. Discuss Dow theory and the technical trading concepts that we talked tonight about on the forums and in the class group on the website. I would suggest that you look at several charts over the next couple of days and watch the trading behavior. And you don't have to look at current. You can just look at historical charts, because historical charts will always look the same in the future. I mean, that's not to say they will always do the same thing, but they're always going to have the same basic patterns. So you can look at historical charts, observe the trading behavior. Now that you understand the price movement ideas and the Dow theory ideas, look at them, look and see if you can determine 3 levels of the trend, look for 3 phases of the trend, all the stuff we talked about tonight. And then in the next class, we're actually going to talk more about line drawing and start to unpack these steps to confirmation so that as a technical trader, you're really set up and you're prepared with the power to be a good market analyst and a good reader of the market. All right. The end. Any questions, comments, or opposing views? Did we get everything covered by the end of the evening? Thank you guys for your nice comments about the new class. I appreciate that. Ryan says, how do you get 100% mastery for level 1? Ryan, the formula, I don't know it, to be honest, but the formula goes something like this. You have to attend all the live classes. You have to take all the quizzes and pass them. You don't have to pass them perfectly, but I think it's like a 70 or 80% proficiency on the quizzes. And then Ryan, if you're still lacking some of the mastery, that is because the formula requires that you get involved. So you got to get involved in the forums and in the group, the class group. Just get in there and post a few times, Ryan, and you will you'll get that mastery right on up there. Okay. You are welcome. Those of you saying thank you, thank you, thank you. Ryan says the only opposing view he has is he has to start the class starts at 5 for him and he can't be here till 6. Ryan, tell you what, buddy, if you want to jump into a late class, it starts tonight. It's going to be level 1 tonight, Ryan. But if you want to jump in there tonight, you can. It starts at 11 o'clock Eastern time, but that's like 8 o'clock if you're in California. So Ryan, that means you're home for it. And that will be level 1 starting tonight, but in a month, that will be level 2, and you can do all these classes at that time. Hopefully that will help you guys out. Thank you, Stacy. I appreciate that. Thank you. Several of you are making comments about how helpful the forums are, and I couldn't agree more. I think they're very, very good for you. Sandra says, are there quizzes for Legacy Foundation 1? And the answer is yes. I see that a moderator said no, but Sandra, the answer is yes. There are, and they are posted up. They're already programmed in there. So Sandra, if you go to your Legacy Foundations Level 1, the quizzing application should have questions in there. If you don't have it, then send an email to, shoot, where do you send the email to now? Send it to success@tradesmartu.com. Success@tradesmartu. Yes, the video will be posted. Yes. Mike says the level 2 quizzes, when will they be available? I thought they were available right now. If they're not, then I will go check it, and that will happen very, very quickly because they're supposed to be up. I thought they were all posted already. So let me do some research on that tonight, Mike. I'll do it as soon as I close the class down. And we will get quizzes rocking for you. So, all right, sounds good. Well, I tell you what, ladies and gentlemen, I'm going to call it an evening. You guys have a fantastic night for yourselves. And if you guys want to join the late class, you want to go back through level 1 tonight, we'll be doing that starting here in just a couple hours. And until Wednesday night, you have a happy night, happy trading, and we will see all of you Wednesday night. Good night.